Sudeep, let me come to you. Pharma as a pack. And I just realized, I mean, Divi's trades at what now? 80 times earnings. I mean, the rally over the last couple of years has been stupendous. What do you do in a situation like this, Sudeep? Give us a sense.
Well, Harsh, overall, we do like pharma. I think this is one sector which is poised for quantum leap. I think, where Indian IT was standing 20 years back, probably pharma is standing there, and the scope for growth is significant. Yeah, there is talk of tariff on generics and things like that in the recent past, but I think these are things which are not implementable, not workable, and will fizzle out at some stage. So fundamentally, pharma does look good. Of course, we have to be cognizant of the high valuations and take a calibrated call on such highly valued stocks. But otherwise, pharma looks good. We broadly divide pharma into three segments. One is where the top pharma companies today are getting into a zone like Sun Pharma, where 70-80% of their products are now branded and patented post the Organon acquisition. So they're moving in a different direction. So is probably some other companies like Glenmark, Cipla, Dr. Reddy's. They will all eventually move towards that direction. Then, of course, there is the CDMO place where there are contract manufacturer, one name or the other. Again, that's a huge area and the scope is significant. The third and the last segment is domestic pharma. And I think there also there is sufficient growth opportunity. So all the three segments, the way we look at it, opportunity is there. We do like Sun Pharma quite a bit. We do like from the first bucket, we do like Mankind Pharma from the last bucket, which is focused on India. CDMO, we have to be very careful while taking your pick because of the valuation, PE multiples at which they're trading now.
While we're speaking, Ajanta Pharma has come out with numbers. Let's pull up that stock as well. Resounding set of numbers, frankly. 21% EBITDA growth, PAT growth at 30%, margins at 26%. Resilient set of numbers is what Ajanta Pharma, I beg your pardon, seems to have posted. So it's, and you can see the spike in the stock price, 3.5% higher right off the bat. Kunal, Ajanta Pharma on charts?
See, I think on the short-term charts, we're looking at Ajanta Pharma being into a very slow, gradual uptrend. Over the last 3 months or so, it's been taking good support. 2,500 approximately was the low in the month of April. For 2,800 approximately was the low for the stock in the month of April. And now it's currently trading at 3,500. But again, it's been a very gradual uptrend for Ajanta Pharma. It's a stock which generally we would probably believe that could be bought into on minor dips or corrections. So, or a mean retracement towards a 20-day moving average. That level is around 3,300, 320 for Ajanta Pharma. So it's a good stock to hold on to. But for a fresh buy, I would suggest to buy on dips.
That's a resounding beat across the board. 1,526 crore is the top line versus an estimate of 1,511 crore. PAT at 334 crore versus the estimate of 294 crore. And nearly 10 analysts tracking this one. So you've got a decent set as well of analysts. And therefore, you're seeing some strength on the stock as those numbers have started to trickle through. So that's on Ajanta. Let's quickly move on though. Merrill here with some of the other stocks that are in focus this afternoon. Merrill, what's on your list?
That's right. So here are some stocks which have seen some momentum in trade today. Starting first with Syngene, that stock is still down after the company's reported a soft set of first quarter numbers, with reporting a net loss of 9 crores after the last year's profit of 87. And they've mentioned that performance was impacted by low offtake from a major client and forex hedging losses as well. On top of that, the company has also revised downwards its full year revenue guidance. So that's what seems to be affecting the stock today. Moving on, IRB Infra has posted good results. Profit is up almost 52% year on year, with revenues also slightly inching up 2%. And margin has seen a massive gap up of 53.9% right now to last year's 45% levels. L&T Foods similarly has seen its net profit rise 9%, revenues up almost 30% year on year, while EBITDA has also jumped up almost 34% on a year on year basis. Exide has also posted its result. They've seen profit up for the company up 30%, revenues gapping up 20% and EBITDA margins also inching up almost 16%. And Ajanta Pharma, that count has just reported its results. In terms of the company's segmental performance as well, we've seen very strong growth on that counter. Apart from the Asia business, which has actually gapped down 16% on a year-on-year basis, the company's branded generics, India, Africa, and all of these markets have performed quite well, with US generics going up 56%, 57 odd percent on a year-on-year basis. And we've seen a good, strong beat on Ajanta Pharma in all aspects: revenue, EBITDA, margins, and PAT. So that's what seems to be driving all of these stocks in trade today.
Absolutely. Thank you so much for that, Meryl. That's with regard to some of the stocks you want to keep on your radar this afternoon. But one of those stocks is LT Foods. Stock is up nearly 5.5% in trade on the back of a strong set of numbers, margins coming in with a good amount of strength as well. Arpit, let me ask you for a chart check on an LT Foods.
If we see overall, I was just looking at the weekly setup. So from last almost 8 to 10 weeks, the stock was trading in a range between 360 to 396 level. And today, finally, the stock is given a major breakout above 393 levels. And that also coincides with this 200 demo. So I think looking at the setup wise, risk reward wise is comparatively favorable, with 3890, 92 was the previous hurdle zone. Once it closes above this level, we can see upside move towards 420 to 425 levels. Along with that, one good part is that volumes also has been significant. So I think closing above 393 will definitely give a head start towards 420 levels. So overall kind of a buy on dip till major support around 385 for an upside move towards 420 plus levels.
Okay. Redington was the other one, which came out with a very strong set of numbers. I'm not sure, Sudeep, whether you track a stock like Redington, but I mean, the numbers look strong. The management commentary looked upbeat. And then you have certain competitors like Rashi Peripherals as well within the same kind of cohort or space. You believe that this space is looking to start heating up largely because you've got this entire huge AI capex theme which is playing out. And as part of that capex theme, you could well see some of these benefit.
Well, Harsh, I'm not very sure about the AI-related benefit, but of course, new models are getting launched and new gadgets are coming to the market, and which does excite these stocks. They get an opportunity to ensure customers upgrade, and even the old instruments which comes back does help overall their business. And so this is probably a season for these companies to do well. A lot of new models are coming from multiple OEMs, and that should keep Redington excited. Also, along with the new gadgets comes the accessories and peripherals, which again, increases their overall profitability and margin profile. So good time for these companies, undoubtedly. Of course, everything will depend on how the economy performs and how the urban consumption or urban and of course also rural consumption picks up. As things stand today, it does look good as far as Redington and even Rashi Peripherals are concerned.
So you still go out and buy, because I was just looking at that chart of Rashi Peripherals that our director was putting up. And stupendous set of returns. Just look at the year-to-date returns. I mean, it's more than a doubler in the last 1 year. You still go out and buy?
Well, I think if I'm looking at it from a long-term perspective, I think these are good stocks to hold in your portfolio. It is like some of your FMCG companies. They will be in demand. They will have business. India is a large country with the most populous country, and the demand for products, electronic products, which is where they specialize with their dealerships of OEMs, they will flourish.
Yeah, I mean, it's a very interesting theme. In fact, we've covered it, Rashi Peripherals specifically in a 30-minute segment on All About Your Company just a few weeks ago. Maybe you can just go on YouTube and check it out if it interests you, that conversation. But let me go across. Avi is here to decode the numbers of M&M, because the numbers were largely in line. Just a wee bit of softness on the margins, you'd say, Avi?
So the numbers for Mahindra and Mahindra have come in, and we can see that there are a good set of numbers since the margin has seen an impact due to the commodity cost inflation. But the overall set of numbers are good since the revenue has increased by 23%, while the EBITDA is up 5%, and the profitability is up by 7%. Talking about the farm segment, the market share has increased by 280 bips on a sequential basis and now stands at 44.9%. While for the auto segment, the SUV has the volumes have grown by 15% on a yearly basis, while for the LCV, it's up by 20% on a yearly basis. Now, one out of every 4 SUV is from Mahindra since the market share now stands at 25% for the SUV segment for Mahindra. Talking about the capacities, we by the end of FY26, they had 64,500 units capacity per year, which they will increase to 82,000 by end of FY27. And by end of FY31, this capacity will nearly be doubled. So a good capacity expansion by Mahindra as they anticipate increasing demand, and their demand for electric SUVs is going through the roof. So all in all, a good set of numbers, but yes, definitely margins were something that was under pressure for this quarter.
Okay, that's the take on M&M. Sudeep, I wonder how you look at or read through M&M's numbers. Just give us a sense.
Well, Harsh, pretty good set of numbers. Nothing to be upset about. Margin, a bit of a pressure on the margins compared to what probably the market was expecting, but that's 20-30 bips only. Also, we have to factor in the input costs have gone up significantly, and that did affect. A couple of things we're looking ahead. One is their commercial vehicle business having been shifted to SML Mahindra, I think is a good step. We will now, and the company will also be now fully focused on tractors, farm equipments, and passenger vehicles, which is predominantly the SUVs, where 25% of market is with them. So this is definitely a good step. As far as the future is concerned, I think with the monsoon having recovered significantly, the tractor and farm equipment segment should continue to see good growth. SUV, of course, they have a very good position in that segment. Electric vehicle segment, they are making good progress. Of course, the future will tell how successful they are. So fundamentally, looking at the numbers, then nothing to complain. The growth trajectory is intact, and the company is becoming more focused. That's also good news.
I'm told I need to let you go. I'm going to quickly take a couple of more questions. SML Mahindra, Sudeep, couple of days back to back, 20% up. Firstly, I want to understand, justified, you believe, based on EV/EBITDA or PE, based on some of its, I don't know if you've had a chance to look at some of their the peer set and probably give us a sense. And second, should an investor get on now onto something like an SML Mahindra?
Well, the answer to your second question is no. Look, they are competing in the segment where there will be Ashok Leyland, there will be Tata Motors commercial vehicle. And in that space, I think, they are a small player. They have a lot of ground to catch up. But yes, obviously the prospects are significant. The future can be very good, but they are yet to prove their performance, their credentials in this segment. So as I was saying that taking it out and putting it in a separate entity is a step in the right direction. It will be more focused, and they will be in a position to directly compete with the big daddies in this segment, which is Ashok Leyland and Tata Motor commercial vehicle. But the performance going forward will prove whether they deserve this kind of euphoria and valuation or not. I will not definitely buy into the stock at this stage. I will wait and watch.
Okay. I wonder also, Sudeep, KPIT Tech, how are you looking at the numbers, the commentary? I mean, it's one of those stocks which is talk of town because of the way in which they came out with their with their provisional numbers at the start of the quarter, or warning as such at the start of the quarter, and thereafter stock has been in turmoil. What should an investor do? Give us a sense of your view.
Well, I have been, Harsh, very careful about this entire technology space, and I believe that we need to be. The AI-related disruption is real, and these are good companies, and they will definitely recover from this phase. But it'll take some time. This pivoting to AI and adjusting to the new environment will take some time. Well, KPIT definitely has an opportunity of doing it probably better than many others, but it'll take some time. So we have to be prepared for some shocks along the way, and that's what probably market is getting at this stage. The management came out and talked about it, and that's a good thing to do because whether you talk or not, I think the challenges on ground are real. So I have been recommending investors to stay on the sidelines, watch this entire thing getting played out. Maybe it'll take a few more quarters before we know exactly who is ready for the AI world, who has been able to pivot their business in that direction, and who is still struggling. But next couple of quarters is going to be extremely volatile, and it's better to be careful.
Cautious with regard to this pack. Thank you so much, Sudeep. We'll let you go. Arpit, very quick.